In this edition of GAAP Chats, we'll take a look at the next step in the new Revenue Recognition Standard, ASC 606. Step 3. Determine the transaction price. In the first two GAAP Chats, we started talking about the new 5-step model for recognizing revenue. So far, we've covered how to identify a contract in Step 1 and identifying performance obligations in Step 2. We now move on to Step 3, determining the transaction price. What's the transaction price of a contract? The transaction price is defined as the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer. Seems simple enough, but this step represents a significant change from existing U.S. GAAP. Under existing GAAP, the transaction price had to be fixed or determinable. However, it's not as clear-cut under ASC 606, as the transaction price may include both fixed and variable amounts, as well as other considerations. This means that the transaction price is actually an estimate made by management, and significant judgment may be involved. However, we must keep in mind that only the amounts likely to be realized can be included. Under ASC 606, the transaction price should include all consideration paid to the customer, such as rebates, as well as any non-cash consideration. It must also consider the time value of money, if significant. However, probably the biggest change is that the transaction price now must include variable consideration. Generally, any consideration payable to the customer, such as a discount or rebate, is reflected in the transaction price, resulting in a reduction in revenue. However, if the payment is for a distinct good or service that the customer supplies the entity, then the entity should account for the purchase in the same way it accounts for other purchases from suppliers. Any non-cash consideration received should be measured at fair value. If fair value cannot reasonably be estimated, the entity should measure the non-cash consideration indirectly by reference to the standalone selling price of the goods or services transferred in exchange for the consideration. The transaction price reflects the time value of money only if there is a significant financing element between the entity and the customer for the purchase. As a practical expedient, entities do not need to consider financing periods that are 1 year or less. Income from financing should be presented separately from the other consideration received from the customer. If the consideration promised in a contract includes a variable amount, entities should estimate that amount and include it in the transaction price. As we've previously discussed, the inclusion of variable consideration in the contract price requires considerable judgment on the part of management. Let's take a deeper look into what might be included in variable consideration. Examples of variable consideration include discounts, rebates, credits, performance bonuses, penalties, contingencies, and price concessions. Although variable consideration is now included in the transaction price, it's not a free-for-all. There's a concept within ASC 606 called the revenue constraint. Quite simply, the revenue constraint states that the transaction price should only include variable consideration, not subject to significant revenue reversal. In other words, what entities estimate as the transaction price should be more or less what they actually expect to collect. There are several factors that may increase the likelihood of revenue reversal, meaning that if they are present, variable consideration should not be included in the transaction price. These factors are being presented on the screen now. To estimate variable consideration, a company needs to consistently apply one of two methods throughout the term of the contract, either the most likely amount or the expected value methods. Let's look at each. The most likely amount method is the single most likely amount in a range of possible consideration amounts. In other words, it's the single most likely outcome of the contract. For example, assume a contract has a 70% chance of receiving $100,000 and a 30% chance of receiving nothing. The most likely amount is $100,000. This approach may be appropriate if the contract only has two or a few possible outcomes. The expected value method is the sum of the probability-weighted amounts in a range of possible consideration amounts. For example, assume a contract has a 70% chance of receiving $100,000, a 20% chance of receiving $50,000, and a 10% chance of receiving nothing. The expected value of these outcomes is $80,000. This approach may be appropriate if the entity has many contracts with similar characteristics and a wide range of possible outcomes. Let's put it all together with an example. Dempsey Outsourcing receives $100,000 for providing call center ordering services. They can earn an additional bonus of up to $50,000 depending on average customer wait times. We've put the various possibilities of average customer wait times on the screen. Obviously, the fixed amount of $100,000 should be included in the transaction price under both existing GAAP and new GAAP under ASC 606. However, under existing GAAP, Dempsey would not recognize any of the variable consideration until the end of the period when average customer wait times are known. However, ASC 606 requires entities to include variable consideration in the transaction price, provided significant revenue reversal is not probable. As we previously discussed, entities can use either the most likely amount approach or the expected value approach when determining this amount. Using the most likely approach, $30,000 would be included as part of the transaction price, since the 45% chance of achieving this outcome is the most probable outcome. The new standard's not clear on how the most likely approach is utilized if there's more than two outcomes. Therefore, you may determine that the most likely approach is not the best methodology here, and instead use the expected value approach to estimate the bonus amount. Under the expected value approach, we calculate the weighted average of the various possibilities. Under this approach, we estimate variable consideration of $29,000 to be included in the transaction price. But wait a second, $29,000 is not actually a possibility. In other words, we're 100% sure that Dempsey will never receive $29,000 because the bonuses are in increments of $10,000. When you're using the expected value method, the company must still select an amount that is possible of being received. Because of the revenue constraint, the expected bonus would be limited to $20,000 until the next bonus level is probable of achievement. This is because anything over $20,000 would be subject to subsequent reversal. And there you have it. We hope this presentation has helped you understand the basics of the third step in ASC 606, determining the transaction price. There are other GAAP chats available for each step of the new revenue recognition model. As always, feel free to contact us with any questions you may have. This presentation has been brought to you by GAAP Dynamics.